This is Jody Trana with Chapter 17 of Business Finance. For this chapter, we're going to talk about how to construct a revenue forecast, develop a pro forma financial statement, and to estimate the firm's financing needs. It's really important to be able to identify what the future financial situation of a company could be so that we know how much financing to find. We can look for financing we've talked about through debt or through equity, but each of those alternatives has different costs. And we just need to know how much we need in order to start to figure out where we should seek financing. Most of the information for this narrated PowerPoint will take place in Excel. We're going to be talking about creating a pro forma financial statement for Murphy forklifts in order to determine what their needs are for discretionary financing. We usually will be given last year's information or the current year's information, and then some statistics or situational information to help us to calculate the next year's financial statements, which we call pro forma. Whenever we are projecting into the future, it's called a pro forma financial statement. So let's take a look at the current year's information just to refresh us on the different kinds of accounts that we have in business. As far as the income statement goes, the only information that we're given is the sales number. In order to determine our financing needs, all we need to know is the sales number. For this particular company, they pay out all of their profits in dividends. So knowing what their net profits are doesn't help us with knowing how much money we need in order to finance our operations because they plan to pay out all of their profits anyway. So the only thing we need to know from the income statement is sales. The balance sheet we have here just separated into a few categories. We have current assets. Those are things like cash, accounts receivable, and inventory. Those are very affected by sales. When we have greater sales, we have greater need for current assets. Our needs for cash go up, our needs for accounts receivable and inventory, they all increase when sales increase. The next category is fixed assets. Fixed assets are our buildings, our equipment, our plant, those types of things. Those do not increase proportionally with sales. That is, if sales increase by 10%, our net fixed assets don't increase by 10%. Our fixed assets grow in leaps and bounds depending on the activities that we're involved in. If we're going to build a new plant, then our fixed assets are going to take a huge jump for the costs of that plant. But otherwise, they don't change a great deal. For accounts payable, this is an amount that, just like our current assets, is going to change pretty proportional to sales. Our accounts payable is going to increase as our sales increase. The notes payable is right now we have 0. The notes payable is a number that we will use to plug in our discretionary financing needs. The bonds payable, these are bonds that Murphy Forklifts has issued already to cover some of their costs. They could increase that number and they could issue some more bonds, but we would be told that in the information if that's part of the plan. So that gets us to total liabilities, and then under that we have our equity. Common equity, that is their stock that they've issued, and again, we could raise money by issuing stock. Right now we're just trying to find out how much money we will need. Then we add together our total liabilities and our owner's equity. That gives us a number of 24 million in this case, 24,230,000. You can see that that equals with our total assets. That tells us that our balance sheet is in balance in correspondence with our accounting equation. which is assets equals liabilities plus equity. The template that you'll be using will show a 0 at the bottom if your balance sheet balances. If your original current year balance sheet does not balance, you'll really need to check that out because the figures you're given will be a balancing balance sheet. So what exactly are we trying to accomplish with this spreadsheet? There's two primary numbers that we're going to be looking at. The first one is our total assets. Our total assets are going to be two primary numbers, our current assets and our net fixed assets added together. Our total assets tell us the total financing requirements. Remember that our accounting equation says that assets equal liabilities plus equity. Another way to think of that is our assets are the things, if you want to put it that way, that our company has that needs to be financed. That's how we make money, through our assets. So our assets need to be financed, and we can finance our assets through either liabilities, that's debt, or through equity. That's things like stocks or owners contributing capital. So our total assets are the first number that we are trying to identify, and that will tell us our total financing requirements for the year. So we've identified that our total assets tells us what our total financing requirements are for the year. But how do we finance those assets? We're going to finance them through our liabilities and through our equity. Much of what we have is existing and will continue to be there. So our accounts payable is going to continue, our bonds payable are going to continue, our common equity will continue as well. So we will have some numbers existing to support these total assets. But as we complete our pro forma balance sheet, we'll probably identify that we need a little help in order to get it to balance. That's the number that we're looking for. If our liabilities and owner's equity comes up short and doesn't quite balance with our total assets, then we'll know how much long-term financing we need, and we'll put that number in our notes payable account. Now let's look at the process of projecting our pro forma balance sheet. Remember that we have just received information on sales, not the rest of the income statement, so we're primarily working on a balance sheet. The first thing that we want to do is calculate some percentages of sales. Remember that we talked about the current assets and the accounts payable as changing proportionally with sales. So we want to find some relationships between those particular accounts and sales. So to find the relationship between current assets and sales, we take our current assets number of 9,920 and divide it by sales of 50,780. Current assets right now are 19.54% of sales. That number is going to come in handy when we project our current assets. The other percentage we'll come up with is our accounts payable as a percentage of sales. And if you take 4,020 and divide it by our sales, you'll get 7.92%. That tells us that accounts payable this current year was about 8% of sales. Sometimes we will be given a growth number that we need to calculate a new sales number. So for example, we could say sales grew by 100%, and then we would just double last year's sales and come up with our new figure of somewhere around 100,000. But this problem did give us the projected sales for the next year of 99,060. So we can just put that into our pro forma income statement. When we project in our pro forma using percentages of sales, we take last year's percentage of sales and apply it to this year's sales amount. So the 19.54 is added into, you can see it's in the green cell here. That came straight from last year's 19.54. We use that percentage to calculate our new current assets number. You do that by taking 99,060 times 19.54. I believe that in my lab, in order to get correct numbers here, you need to use 3 decimal points for your percentages. The next number is our net fixed assets. In this problem, we're told that our net fixed assets did not change. If it does change, it will change in leaps and bounds based on the costs of a project and not as a percentage of sales. So we can add together now our assets, and we can see that our total financing requirements for the next year are $33,666. That's the amount that we need to be able to cover through our liabilities and our equity. Now that we know how much financing we need, we can start chipping away at our sources of financing through our liability accounts and our equity accounts. So the first one is accounts payable. We're going to calculate this the same way as we did our current assets. That is, we take the current year's 7.92% that we calculated, that represents the relationship between accounts payable and sales. And we're going to take that number and multiply it times our next year's projected sales. So 99,060 times 7.92% will give us an accounts payable on our pro forma balance sheet of $7,845. Unless we know that we have issued additional bonds, our bonds payable account won't change. So right now in our balance sheet, we have 18,705 total liabilities. We also have common equity of 9,350. That gives us total common equity of 9,350. So right now on our first run through, we have total liabilities and owner's equity of 28,055. You can see where the current year had a 0 to show that the assets equal the total liabilities and owner's equity. Our pro forma balance sheet does not have a 0. Look back up at the total assets. Total assets are 33,666. But the total liabilities and owner's equity that are going to support those assets are only $28,055. That's a difference of $5,611. We're going to put that number into our notes payable. That becomes our plug figure, and it also tells us what long-term financing we need for the next year. $5,611 is our discretionary financing that's needed. Right now we're putting it in the notes payable area just to get our balance sheet to balance and to identify that that is definitely the dollar amount that we are projecting that we need. We can later choose to issue bonds to cover that, issue stock. Those are decisions to come. Right now we're just putting it in notes payable as kind of a placeholder. So the two figures that we are most interested in here are the total assets and the notes payable. Total assets tells us our total financing requirements. The full $33,666,000 of assets must be supported through liabilities and equity. We had some existing, and that's great, but we found that our liabilities and equity were not quite great enough to support the full total assets, and that we would need to come up with some additional long-term financing to support those assets in the amount of $5,611,000. Right now we put that in notes payable, and that is identifying our discretionary financing needed. It's certainly possible to come up with a negative imbalance. That would be if your total assets are less than what your total liabilities and owner's equity are. When this happens, it just indicates that you have created enough support for your assets and that you do not need to additionally borrow or issue bonds or issue stock in order to cover your next year's needs.